Feeling like the IRS is always watching, always ready to snatch a piece of your hard-earned retirement savings? You're not wrong. Roth IRA conversions promise a golden ticket to tax-free retirement, but they're absolutely littered with hidden tax traps that can turn that dream into a financial nightmare. Most people, even so-called experts, fumble these, leaving thousands on the table. Today, we're going to navigate these traps like pros, exposing the system and showing you how to stick it to the man, legally, by protecting your money. Now, a Roth IRA conversion sounds fantastic, right? You take money from your traditional IRA, pay the taxes now, and then watch it grow completely tax-free for the rest of your life. No more worrying about future tax rates, no required minimum distributions breathing down your neck. It's like buying peace of mind on layaway. But here's the dirty little secret. The IRS rules around these conversions are deliberately complex, designed, it seems, to trip you up. Most financial advisors, they'll tell you the basics, maybe even hand you a brochure. But they rarely dive deep into the real-time risks, the insidious ways the system can catch you off guard. They don't want to complicate things. Or worse, they just don't fully understand the nuances themselves. Well, I'm here to tell you, that's not good enough. You work too hard for your money to leave it vulnerable to hidden taxes. We're about to uncover the 3 biggest Roth IRA conversion tax traps that most people, and even many pros, completely miss, and how you can sidestep every single one of them. Get ready, because what you don't know times will times cost you. Alright, let's kick this off with one of the most talked about yet consistently messed up strategies in the retirement world, the infamous backdoor Roth. This is where high-income earners, who are otherwise blocked from contributing directly to a Roth IRA, contribute to a non-deductible traditional IRA, and then immediately convert it to a Roth. Sounds clever, right? A loophole? A way to beat the system? Not so fast. While the backdoor Roth can be a legitimate strategy, it's also a giant, gaping trap for the unsuspecting. And here's why. Most people completely ignore the pro rata rule. Now, if you have any time other traditional IRAs, that includes SEP IRAs, simple IRAs, or even old rollover IRAs from previous jobs, then you are in serious danger. The IRS doesn't care that you just contributed a non-deductible amount to a asterisk new times traditional IRA. When you convert, they look at times all traditional IRA assets, lump them together, and then calculate what percentage of that total is pre-tax money versus after-tax money. This is the pro rata rule, and it's a total scam designed to make sure you pay taxes on money you thought was already after tax. Let me break this down with a quick, painful example, because this is where advisors often gloss over the details. Let's say you have an old traditional IRA with $90,000 in pre-tax contributions and earnings. Then, you contribute $6,500 after tax to a brand new, non-deductible traditional IRA with the intention of immediately converting it. Your total traditional IRA balance is now $96,500. When you convert that $6,500, the IRS doesn't see it as a clean, tax-free move. Oh no. They see that $6,500 as only a portion of your total IRA assets. If $90,000 out of $96,500 is pre-tax, that's about 93%. So when you convert your $6,500, roughly 93% of that $6,500, or about $6,045, will be treated as taxable income. You thought you were converting $6,500 of after-tax money, but the IRS just hit you with a tax bill on over $6,000 because of your other IRAs. That's money you've already paid taxes on once. This is exactly how the system is rigged. It's an unexpected and frankly infuriating tax bill that can completely derail your backdoor Roth strategy and leave you feeling utterly ripped off. This isn't just an oversight. It's a foundational misunderstanding that costs people thousands, proving that you simply can't trust the surface-level advice. You need to understand the gears grinding beneath the hood. Now, if the pro rata rule wasn't enough to make your blood boil, let's talk about the tax bracket tango. This trap isn't about avoiding taxes on existing money, but about accidentally pushing yourself into a higher tax bracket when you convert a large chunk of your traditional IRA to a Roth. Most people, in their enthusiasm to get money into a Roth, think, great, I'll convert $50,000 this year, pay the tax, and be done with it. What they often forget, and what many financial advisors conveniently gloss over or simply don't emphasize enough, is the concept of tax bracket creep. When you do a Roth conversion, the amount you convert is added to your taxable income for that year. If you're already earning a decent salary, pushing an extra $50,000 $100,000, or even more into your income can dramatically change your tax picture. You could easily jump from the 22% bracket to the 24%, or even the 32% or 35% bracket. And here's the killer. It's not just the converted amount that gets taxed at the higher rate. Once you cross into that new bracket, all your income that falls within that higher bracket is taxed at that higher rate. This means you could end up paying a significantly higher percentage on all your income, not just the money you converted. This is a classic case of short-term pain for potential long-term gain. But if you don't do the math meticulously, that short-term pain can be excruciatingly expensive. I've seen countless cases where individuals, eager to embrace the Roth lifestyle, convert too much, too soon, and end up with a monstrous tax bill that year. They effectively pay more in taxes times now than they ever would have in retirement. And let me tell you, if your Roth conversion strategy means you're paying more in taxes today than you would have in the future, that's not just bad financial planning, it's borderline financial sabotage. You're actively hurting your current cash flow, and for what? A hypothetical future benefit that might not even materialize if tax rates actually go down, or if your retirement income is lower than anticipated. This is where conventional wisdom fails you, suggesting just convert, without considering the real-world impact on your wallet today. It's a prime example of why you need to question every piece of advice and truly understand how these numbers interact with your time-specific financial situation. Don't let someone else's generic advice push you into a higher tax bracket you could have easily avoided with a little planning. Now you've somehow navigated the pro-rata minefield and dodged the tax bracket tango. You're feeling good. You've got your money in a Roth, growing tax-free. But wait, there's one more sneaky trap. A silent, ticking time bomb that most people, even those who think they're savvy, completely overlook. The 5-year rule fiasco. When we talk about Roth IRAs, there are actually 2 different 5-year rules, and confusing them can cost you big. The first one applies to your initial Roth IRA contribution. Once 5 calendar years have passed since January 1st of the year you made your first Roth contribution to any Roth IRA ever, your earnings in that Roth become qualified for tax-free and penalty-free withdrawal in retirement, provided you're also over 59.5 or meet certain other conditions. That's generally well known. But the second 5-year rule, the one that's a genuine trap for conversions, is often ignored. This rule states that for each individual Roth IRA conversion, you must wait 5 years from the date of that specific conversion before you can withdraw the converted amount tax-free and penalty-free. Let me be crystal clear. We're talking about the converted principal here, not just the earnings. If you pull out money from a conversion before that 5-year clock runs out, the IRS will hit you with a 10% early withdrawal penalty on the taxable portion of the converted amount, even if you're over 59.5. Your earnings will also be penalized and taxed if they aren't qualified. This is a crucial distinction that trips up countless investors, especially those who do large conversions or those who anticipate needing access to funds sooner than later. Imagine this. You convert a big chunk of your traditional IRA to a Roth in 2024. Then, an emergency hits in 2026. Maybe a sudden medical expense, a job loss, or you just need quick cash. You think, great, I'll just pull from my Roth, it's tax-free. But because that specific conversion was less than 5 years ago, you're looking at a hefty penalty. It's like the IRS is saying, nice try, but you tried to move too fast. This isn't just some technicality. It's a real consequence for anyone not planning their liquidity needs carefully. This rule is a ticking time bomb, especially for those looking to access converted funds early, or for anyone who thinks a Roth conversion is a magic key to immediate, penalty-free access. It highlights the absolute necessity of thorough planning. You can't just convert and hope for the best. You have to plans. And that means understanding this 5-year rule for every single conversion you make. Don't let laziness or a lack of detailed information turn your Roth conversion into a costly mistake. This is why I always say, never trust generalized advice. Your financial future demands specific, meticulous planning. So you've seen the traps. The pro-rata rule, the tax bracket tango, and the 5-year rule fiasco. These aren't minor speed bumps. They're craters designed to swallow your money. But here's where the Wall Street rebel comes in. My strategy isn't just about identifying problems. It's about empowering you with the knowledge to fight back and win. First and foremost, when it comes to Roth conversions, you must thoroughly understand the pro-rata rule. Before you even think about a backdoor Roth, Consolidate all your traditional IRA assets. If you have old 401ks or 403bs, explore rolling them into your current employer's 401k if allowed, or even a solo 401k if you're self-employed. This removes them from the traditional IRA bucket, effectively allowing your non-deductible contributions to be the only traditional IRA money you have, making your backdoor conversion truly tax-free. Don't leave a single penny in a traditional IRA that isn't already after tax if you're trying a backdoor. This is your first line of defense against the IRS's sneaky accounting. Second, you absolutely must carefully analyze your current and future tax bracket. Don't just convert blindly. Get out your tax software, run scenarios, and project your income. Consider converting smaller amounts over several years to stay within a lower tax bracket. This is called tax bracket harvesting, and it's a powerful tool the average advisor might not even mention because it requires more hands-on planning. Instead of one huge, painful conversion, make multiple, smaller, less impactful conversions. It's like death by 1,000 paper cuts, but in reverse. 1,000 small tax wins leading to one giant victory. This methodical approach ensures you're never paying more taxes today than you need to. A critical principle for smart wealth building. And third, always factor in the 5-year rule for each conversion. Don't treat your Roth IRA like an emergency fund that you can tap at any moment without consequences. Understand that any converted principal is locked up for 5 years from the date of that specific conversion to avoid penalties. Plan your liquidity accordingly. If you think you might need access to funds, perhaps only convert what you are absolutely certain you won't touch. This requires foresight and discipline, qualities often missing in the get-rich-quick mentality pushed by so many in the financial world. But here's the most crucial piece of advice I can give you. Do your own research. Don't blindly follow financial advisors. Many are decent people, but they often operate on conventional wisdom. Or worse, they're beholden to sales targets. They might not delve into the intricate details of your specific situation that could trigger these traps. Challenge their advice. Ask probing, uncomfortable questions. What about the pro rata rule if I have an old SEP IRA? What specific tax bracket will this push me into? What are the exact dates for the 5-year rule on this conversion? And what are the penalties if I touch it early? If they can't give you clear, concise, and personalized answers that make sense to you, then they're not the right advisor. Seek out those who empower you with knowledge, not just tell you what to do. You are the ultimate guardian of your wealth. And in this game, ignorance is not bliss, it's just expensive. Take control, understand the rules, and don't let anyone else dictate your financial future. So, to recap the Wall Street Rebels Guide to Avoiding Roth IRA Conversion Traps. First, eliminate your traditional IRA pre-tax balances before any backdoor Roth. Second, don't just convert. Meticulously plan your conversions to avoid the tax bracket tango. And third, respect the 5-year rule for each conversion. This is not your emergency piggy bank. Now, if you want to dive even deeper, I've put together a comprehensive, free guide on Roth IRA conversions, packed with insider tips and tricks that even most financial advisors miss. You can grab it right now by clicking the link in the description below. It's got detailed scenarios, checklists, and everything you need to execute your conversions flawlessly and without fear. And speaking of flawlessly executing your financial strategy, are you wondering which retirement account is truly best for you? Your 401k, a traditional IRA, a Roth IRA, or something else entirely? Then you absolutely need to watch my next video, The Ultimate Guide to Choosing the Right Retirement Account, which is popping up on your screen right now. Click on it to keep building your financial fortress and stay financially savvy, and keep fighting the good fight.